we're in the middle of a massive boom bust cycle, and we've been here for a while. There's no telling when we're going to get out of this. We know the bigger the boom, the bigger the bust. We learned this. We learned this from history.
This is Mark Spitznagel, and he predicts that the stock market may lose over half its value in the near future, the most it's ever lost. So who is Mark Spitznagel, and why should we trust him? Mark predicted the dot-com bubble crash and the crash of 2008, and was able to make billions from these crashes at his fund, Universa Investments. Why is Mark seeing a bubble right now and thinking that there is going to be another historic sell-off like in 2000 and 2008? Let's uncover his reasons as well as some strategies on what to do to profit off the big sell like Mark will in the future. The first thing Mark is seeing that is wrong with the economy is the $34 trillion in debt that the government has amounted to.
It's that we must stop this disastrous spending of other people's money by the federal government in such a way that we are destroying the future of our kids and grandkids.
A recession could happen due to this debt, requiring future tax increases or spending cuts to accommodate future interest payments. This reason was actually one of the prime reasons as to why Warren Buffett decided to sell off a lot of his assets in the last couple of months. Warren Buffett fears that these increased taxes to meet the interest payments could hurt businesses' growing profits, one of the main reasons some stocks are valued so high right now. For example, Palantir is trading 230 times higher than its yearly profits due to its ability to grow its profits in the future. Now, if the government raises taxes and digs into these returns, then the market will feel those effects. The government will not be able to keep on this endless cycle of ballooning its debt, and the consequences of trying to lower this debt could lead to a recession. Mark sees this as one of his key points in believing that a major sell-off could occur.
So I think what you saw Friday is people got a little bit, shocked or scared out by that weak labor market report, and that's just going to be an ongoing process.
Wall Street has become very fragile over the last decade, and minor sell-offs in the market could cause a panic within the market that leads to a major sell-off. A government policy that could benefit lowering the debt would hurt the economy and could send a wave through the stock market and lead to a major sell-off. Mark doesn't believe this is the only reason the market could decline, though. He also believes that we are in an AI bubble that could break at any point in the near future.
Today I think similarly, analogously, we are living through just a massive AI bubble
without causing a crash, because I can tell you, never happened in history, and I can't even compare past bubbles to this bubble, given how global and pervasive it is.
Mark points to many similarities from the dot-com bubble back in 2000. Both in 2000 and now, the market is heavily investing in the future advancements that will revolutionize the future. Back in 2000, the internet was this revolutionary industry that quickly got overvalued due to the potential the internet could lead to. We are now seeing the same thing with artificial intelligence. The potential for artificial intelligence is so immense and will probably transform our world like the internet did, but right now is severely overvalued for the current real value of AI. To put this into context, the S&P's PE ratio, or the price of the company over the earnings it generates, was at roughly 44 back in the dot-com bubble. The current PE ratio for the S&P is 35, as investors believe these companies will one day generate 35 times the amount of their current revenue. Another reason Mark brings up is that the market is much too concentrated in just a couple of stocks. Back in the height of the dot-com bubble, 5 stocks were 27% of the S&P's value. Today, the top 5 stocks, those being Nvidia, Apple, Amazon, Microsoft, and Google, make up 39% of the S&P, causing the market to heavily rely on the performance of just these 5 companies. All of these companies heavily rely on technology and the booming of technology advancements such as AI in the future. The last key reason as to why the market is constantly spitting out returns month over month that David mentioned was due to index funds.
The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and it would come to $51 million now.
Many working class people pour their retirement savings into these index funds that just keep growing as more and more people begin building their retirement portfolio. These index funds allow for people to invest in a wide range of stocks and feel comfortable with their investments. So, these index funds flood the market with buy orders, pushing up the price as time goes on. And like Mark said at the beginning of this video, is that the bigger the boom, the bigger the bust. And with the stock market booming like never before, we can predict that we may have a crash like never before. But like Mark did back in the 2000 crash and in the 2008 crash, we can make big profits off of the potential biggest market crash of all time. The first way we can capitalize off a big sell-off is by betting that the market will go down. The easiest way to do this is either by selling call options or buying puts on the S&P. When you buy a put or sell a call, you are guessing that the S&P will either lose value after a certain point or not reach a certain price after a set amount of time. Buying puts can be a cheap way to hedge your bets on the market if the market does have a major sell-off of 50%. Another way you can profit off a big sell-off is by buying back shares after the market has started to reverse back in a positive direction. The market on average continues to build an average return of 8% per year, and getting in after a big sell-off could be the best time to invest in the markets. However, be careful when betting against the market. Although Mark makes fair points, the market is quite unpredictable and continues to grow at an exponential rate like never before as Mark waits for the big sell-off. I made this video to inform about what could potentially cause a big sell-off in the future. So when buying puts or holding cash, be careful to not overdo your risk into one position and make sure to invest only in what you can afford to lose. This was my first video here on Money News, and if you guys enjoyed the content, please give me a subscribe. Thank you guys. See you in the next video.